Louise Yamada is a market technician and also runs Louise Yamada Technical Research Advisors. Welcome, Louise. It's good to see you.
Lovely to be here.
Tell me, is there a bottom in sight? Is there any hope? Can we go back historically? You know, I keep typing back dates in history to try to get some understanding of where we can find some comfort.
Well,
does that exist?
It's a little disconcerting because the S&P in particular looks like this massive double top, and it slightly broke the 2002 lows yesterday, and I'm not terribly sanguine about whether or not a one-day bounce is going to help us. We've seen
when you
these
talk
before.
about when you talk about a double top, it almost looks like a mountain, a Twin Peaks.
Twin Peaks.
What
exactly.
happens on the other side of that second peak? I mean, is there a valley floor somewhere?
That's the interesting part of it. I don't know if you have the chart to put up, but the consolidation that took place at the 2002-2003 lows took place over a year. If you look at the S&P from a monthly perspective, you have just a straight down to that level.
Where would that put us now? Would that put us at what, S&P at 600 or?
If we broke through, if we actually turned around and today wasn't just short covering, or was just short covering, we go lower later. Yeah, that would be our first target.
Is 600.
600. Yeah.
And what happens? Just to get all the gloom and doom out, what happens after 600? We go to free fall, and do we dig through the earth and find ourselves in the basement?
Well, we continue to watch all of our indicators, and one of the things that's been quite stunning is that since May, our relationship of up to down volume on a daily basis has remained extremely deeply oversold. Now, oversold is the empirical evidence of selling. You don't want to go in when a reading is still oversold. You want to wait until that oversold is alleviated. And these are some of the deepest oversold readings that we've seen historically. And it's going to take time for that to repair, I think, if we're going to see something that you could call a sustainable rally.
Earlier in the program, I was talking to Marshall Front and Peter Bookvar, and we were talking about who's going to be left standing. In other words, if people continue to sell, there are some individuals or institutions where they are just naturally long the market, and they're not levered. In other words, you've gotten rid of all the levered players, you've gotten rid of all the speculative players. Is there a sort of a core group of equities that you think are going to, let's say, at least hold their own in a market like this?
That's one of the interesting observations, and that is that it's very different from, say, the last bottom of a bear market, which was 1982, where we saw capital goods capitulating, of course, but the consumer goods had these 30-year bases ready to come out. We don't have any bases this time. We have top after top after top. So the distributional pattern in unwinding this 30 times or 40 times leverage that has been the greed of these past few years is quite extraordinary. And I think it's going to take a lot of time to overcome it. At the very least, you know, the concept, the greater the decline, the longer the need for repair. I think you're looking at several years. This is the 2002 to 2008 period has tracked identically the 1932 to 1938 period, which we've been tracking since 2000, 2002. And the extraordinary aspect of that is that now we have seen that 49% decline that took place in 1938. And thereafter, assuming we even hold at these levels, there were several years of backing and filling and repair. Structural bear markets last for 13 to 16 years. This is still the 2000 structural bear market. What we may have done is created a second bubble. First one was technology, the second one was everything else. So we're watching very
13
carefully.
years, 13 to 15 years, 16 years for a structural bear market.
Yeah, think of 66 to 82. Think of 1929 to 42. So if we've been tracking the 1929 experience, which is the alternate cycle to ours. You know, Elliott Wave's alternation of cycles suggests that every current cycle should be less like the immediately prior and more like the alternate. So way back in 2000 when we saw the market topping, we said, all right, expectations of this bear market should be less like the 1966 to 82 period, which was inflation and rising rates, and more like the alternate, which was 1929 to...
Louise, we've been trying to find some silver lining in all this, and talk a little bit about duration, the idea that, confidence takes time to rebuild. When you look at a chart, which is really just an expression of buying and selling, what do the charts tell you in terms of how long does it take for people to sort of therapeutically recover from such a crash that we've experienced?
Well, it does take time. The bigger the drops, the longer the need for repair is the old quip. But if you were just to look at the 2002 to 2003 period, that stabilization took a year plus before the market was really ready, saw the stocks moving into what you could call stronger hands that were becoming confident that they wanted to hold certain things. And in that period, we saw the establishment of basings, consolidations taking place in the industrials, in the energy, in the rails, and those turned out to be our leaders for the last 5-year run, so to speak. So right now, we have had a real deterioration in all of those. I mean, the first was the home building, which we identified in December of 2005, and then financials in 2006 into 2007, and then the leaders, so to speak, have followed suit. So at the moment, there's a lot of repair that has to take place before we're going to be able to identify what is going to take us out on the other side of this.
Tell me a little bit, if you can, about the market internals, things like put-call ratios as well as advanced decline lines. Are those indicators giving you any sense that that we've hit a capitulation moment?
No. Not yet. Very deeply oversold, our 10-day advanced decline. The cumulative AD is at a new low, but that one doesn't usually give you bottoms. And as I said, the volume momentum is at one of the deepest oversolds that we've seen. So that's going to take time, too. If you have one rally day, today's statistics are not going to take us out of those oversolds. Today's statistics may well have been short covering, notwithstanding the perceived good news. But I think it's going to take more time and probably more backing and filling. And remember, people have lost so much money that you get a good rally in the equity markets, somebody's going to be selling into it.
They want to get out before the getting is good.
Exactly.
We've got about 10 seconds. I just want to ask you, what element of sort of generational and behavioral finance, if you can use that term, are we in right now? I mean, where should people be looking for some guidance as to what to do right now?
Well, I think the alternation of cycles is very telling, because we don't necessarily, as you mentioned on break, pay attention to our parents, but people don't want to go back and study the history of the grandparent generation, and that's the whole point of the alternation of cycles.
All right, thank you very much, Louise Yamada. I guess we're going to have to read about our grandparents. That may be the
That's the third.